Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
I love deadlines. I love the whooshing sound they make as they pass me. I finally organized my life. It turns out it was hiding under miscellaneous. Experience is the art of recognizing a mistake the second time you make it. I started a new diet. It's called waiting until I'm actually hungry. Revolutionary. Time management is just deciding which fires to ignore.
Global markets have narrowed the gap lately, but US equities still trade at about a 40% forward PE premium. Roughly 27x versus 19x for the rest of the world. That's a hefty confidence tax. The justification, big tech's capital flight, high margin dominance. But with AI driving capex sharply higher, these firms may start looking less like sleek software platforms and more like capital-hungry industrials. And markets don't usually hand out 27x multiples to companies laying concrete. If the asset-light genius narrative softens, the valuation spread could compress, not with a bang, but with a re-rating. Stack these two charts and the story gets interesting. China's US Treasury holdings have slid from the 2013 peak to roughly $680 billion today. A steady diversification move, not a financial tantrum. But here's the kicker. While Beijing has been lightening up, others have been loading up. Japan, the UK, and a cast of financial middlemen, Luxembourg and Cayman, are happily absorbing the supply. Translation for markets, the US funding machine isn't reliant on one big creditor anymore. Ownership is broader, more distributed, and arguably more stable. For bond traders, this means less China dumping drama, more focus on yields, deficits, and Fed policy. Look at the 2025 port rankings, and the message is blunt. Global trade still sails through Asia. Shanghai alone moves about 50 million TEUs, Ningbo, Shenzhen, Guangzhou, Qingdao, all heavyweights. Singapore remains the indispensable middleman at nearly 40 million. Europe, only Rotterdam cracks the top 10. This is not a cyclical story, it's structural. Manufacturing, export hubs, and supply chains are clustered in Asia, and shipping routes follow gravity. Ports aren't just cranes and containers they leverage. Control the flow of goods, and you're quietly influencing pricing power, supply chains, and even geopolitics. Elon Musk's net worth is hovering around $670 billion, and now SpaceX's planned IPO may come with a familiar twist. Dual-class shares. Translation, public money, private control. This structure would give insiders super voting power, letting Musk steer the rocket ship even with a minority stake. It's the same playbook used by Meta and Alphabet. Founders keep the wheel, investors get the ride. Supporters call it long-term vision, critics call it shareholder democracy with training wheels. Either way, the markets usually tolerate it, as long as performance keeps defying gravity. McKinsey estimates India could add nearly $1.3 trillion in new activity by 2030, taking high growth sectors from $690 billion today to as much as $2 trillion. And this isn't a one sector sprint, it's a synchronized expansion. Urban construction alone could approach $500 billion. Travel and tourism may double. E-commerce could quadruple. Add semiconductors, auto components, cloud, EVs, and you're looking at an economy upgrading both its physical and digital backbone at the same time. The real shift, these industries are moving from emerging themes to core infrastructure. That's when capital flows accelerate. Over 2.16 lakh Indians now report annual incomes of about 1 crore. That's 61,000 added in just 1 year, and nearly double the count from 5 years ago. This isn't just wealth creation, it's income formalization, business scaling, financial markets deepening, all happening at once. Look at the map and the concentration is clear. Maharashtra leads, followed by major industrial and tech states. Capital is clustering where enterprise, markets, and infra intersect. When high-income taxpayers rise this fast, it signals expanding opportunity, but also intensifying competition.